Let's turn to Truist Keith Lerner, talk about this market, Keith, as we are right at those all-time high levels intraday that we got in July. Your take is to keep playing with what's working, right?
That's right, Carl. I think this market deserves the benefit of the doubt. And what got you here is still the growth sectors. It's the technology, it's communication services. You also have industrials at all-time highs today. And, the banks continue to act well as well. So you put that together with also today the economic data, right? The economic data showing the economy may be cooling, but it's certainly not collapsing. When you look at initial jobless claims moving down, you have retail sales that are solid as well. And the earning estimates for this market continue to move higher. So, again, we would stick with the underlying trend, which still seems positive in our work.
You're right about claims, down 5 straight weeks. We haven't had a streak like that in a couple of years. Retail sales, second best print of the year. Your point on rates, I mean, is the market warming up to a 30-year that can sort of float around 5?
Maybe around 5. I think the main thing is the velocity of the move up. But the interesting thing is, historically, the market has tended to focus a lot more on the 10-year. And what was interesting to me today is despite that kind of really solid economic data, the 10-year Treasury is somewhat flat. I think more problematic for the market is if you started to see the 10-year accelerate 470, 480. But today, overall, a good day. You have good economic data, 10 years flat, and the cyclical areas of this market are acting well.
Right. Where do you think, what's the thinking right now, Keith, on how hedges are supposed to work, right? All the hedge plays that we had earlier in the year, whether that was gold or buying more defensives and equities. I mean, is that playbook getting smaller?
I don't know if it's getting smaller. I mean, we have to think that, we certainly had some broken glass, in the first half. Our theme was a bull in a china shop. We'll likely have some more broken glass in the second half. We still have gold as a diversifier in our portfolios. What we've noticed is when we see stocks and bonds down, gold has been up the majority of the time this year. So I want to get rid of your hedges because things are feeling good. But I would say I would still be more focused on the equity side, and we still see more upside, overall in this market.
One big story of the first half, of course, was the outperformance of international and ex-US over the S&P. Do you now have international at a neutral?
We have moved international up to a neutral, but we're still Team USA. We still have a U.S. bias. In some ways, Carl, what we saw with international was it had underperformed by the most since the 1990s last year. So we saw some mean reversion this year. Over that last 18 months, U.S. is still outperforming. But on the margin, I think things are a little bit better. You have a dollar hedge. You have more stimulus there. And the main index there has broken out of a multi-decade range. So I think on the margin, we're somewhat more constructive, but we would still have a greater allocation to U.S. large caps and the growth sectors.